Now, the Fed's split decision reflects an unusually uncertain time for the economy. Oil prices are volatile, up sharply today again. That is on the renewed fighting in the Middle East. They fell sharply last month on a tentative ceasefire, which eased headline inflation. Now, the economic impact of AI is another big unknown. Chip stocks are down sharply this week as investors grow skeptical of the massive data center build-out. That could put a damper on what's been a real driver of growth in the last couple of years. Loretta Mester is the former president of the Cleveland Fed. We can think of no better person, someone who was around the table not that long ago, because he's calling this a family fight. He says it was a good family fight. So 3 dissenters, what does this division tell you, if anything, about where the Fed might go next? And if you'll allow, you are a friend of this show, so I'm just going to put it out there for you. Would you have raised rates today?
So I probably would have voted to raise the rate today, although I understand why some people didn't think it was necessary at this juncture, just because we did get a pretty good read on inflation, the last report. So, this is really a question of, do you believe that policy at the current setting is well calibrated for getting inflation back down to 2%? It's hard for me to really think that the current level of the funds rate is restrictive. And therefore, I think they're going to have to eventually bring that rate up. But whether it be today or September or even the next meeting, I think that is where the debate should be. And I think that's what they talked about at the meeting, because that's really the question.
You think that's what the family fight was about?
What we saw, that was what the family fight was about. But I mean, I don't like that word, because it almost sounds like we weren't expressing our views about policy when I was on the committee. And that is very far from the truth, right? Everyone would come to the meeting and express their views about policy, about the economy, about their outlook, where they saw the risk, and therefore what they would support on policy. So we've always had those discussions, at least in my time at the Fed. And I've been going to FOMC meetings for many, many years, even before I was on the committee itself. So we've always had that. I think what Kevin was trying to articulate when he came into the job is that he really welcomes that kind of debate. And so I think we've seen that. I think they have some real hard decisions to make going forward. The economy seems to be still holding up very well. Labor markets are in balance in terms of not adding to inflationary pressures, but not pushing them down either. And they have inflation that's been above target for over 5 years now. Eventually, you can say you're committed to 2% inflation, and we all were, but you eventually have to take an action to underscore that, if you believe that policy isn't well calibrated to getting inflation back down to 2%. And that's what we really missed, or I missed in the press conference, is really, well, what's their rationale? What do they see in the economy? Where do they see the economy going? Where do they see inflation going? And what's the narrative around the inflation path going forward? We didn't really get, well, I at least didn't feel I got that in the press conference. Maybe we'll get more information about that when other speakers go out and give their views about the economy, and we'll probably get a little bit more, as we did last time, in the minutes. But I was missing that. I would have liked to have heard more from Chair Warsh about how are they actually coming to these decisions.
Right. And again, making the point, if you're firm on 2%, you didn't start raising rates today. So what is the data that you're looking at? To that point, though, he did say that he might look beyond CPI. I mean, look, we'll take a look at CPI right now. It was a bit soft in June, but kind of worrisome before that. And here we are again to some more supply shocks here. So when he says that he wants to understand underlying inflation, what does he mean? Does he not trusting the data that he's getting right now on inflation? We just have this consumer price index up now.
No, this is exactly what the Fed has been trying to do all along, which is any month's number can be up or down because of special factors. It really is, where is inflation going? What's the underlying trend in inflation? Sometimes you'll have an oil price shock that's very short-lived, and you'll get a higher reading because gasoline prices went up, but then next month they're down again. You want to sort of abstract from that and really get a sense of where is inflation going. And I think that's what he means. And of course, the Fed, for many, many, many years in my time, we've looked at a lot of different inflation indicators. Our goal is set in PCE, inflation, right? But we always would look at many, many indicators because we really wanted to get a sense of where is inflation going. I think what's troubling about the current period is even before the war in Iran started, inflation, taking away from the tariffs, was not on a downward path to 2%. In fact, it had start, if you looked at services, ex housing, it started moving up again. And I think that's when more of the Fed members got more concerned about inflation, because the whole narrative was, okay, we're going to be able to like leave the rate where it is and inflation will resume moving down to 2%. And I think the current data is really pointing in the opposite direction.
And consumers and businesses are really feeling that. And yet, can you explain something to us? You know, the central economic challenge for the Fed, and if it gets even more complicated, is that you have this elevated inflation, but so much of it is due in part to supply shocks, whether it is the energy crisis, whether it is tariffs. And yet, Loretta, will raising rates really fix that? Because that's not what we're used to in this economy, right? It is not sometimes very effective to raise rates. Sometimes it won't bring down inflation in those conditions, right?
It really depends on how long you think supply and demand are going to be out of balance, right? So you're right. The usual story is you get a supply shock, like an oil price shock. By the time the effect of the Fed's rate increase would affect the economy, the supply shock would be over, and then you ended up doing the wrong thing. But what we've seen over the past, post-pandemic period is it wasn't just one supply shock. It was a supply shock and rolling and serial supply shocks that never abated, right? They were just layered on top of each other. Some of them eased off, but you never got the relief. And so you've had supply constraint for quite a long time. And that means the Fed does need to recalibrate, likely, to bring demand and supply back into better balance. They also have to be prepared that, okay, once you're back into balance and inflation does start to come down on that 2%, then be prepared to take off that restrictiveness. So I think in this environment where supply is moving around and demand is also moving around, they just have to be more nimble than they've been, right? They have to recognize that you're always looking forward, right? If supply and demand are allowed to remain out of balance for a long time, you'll be in an inflationary period for longer than you want to tolerate, and therefore you're going to have to act. I think they're not there yet, all of them, but obviously we had 3 members today who thought this is the time to start recalibrating policy. And we'll see if the data comes in and persuades more people, or perhaps dissuades people and says inflation is moving back down. We'll have to wait and see.
Loretta Mester, from someone who was in the room for so many years, we appreciate it. We note you would have raised rates today. We will see what happens in the next meeting. Loretta Mester for us. Thanks so much. Really appreciate it.